what I'm really interested in seeing is by when it gets to 12,000, and it will get to 12,000 because they keep printing money. By the time it gets to 12,000, what will the monetary base look like? What will the money supply look like? What will interest rates be? Will we be in a tightening phase and a loosening? Like that's what I want to know. But the real question is not how far will gold go, but where will the dollar be? What will the money supply be by the time gold gets to wherever it gets to?
We saw that there was a huge acceleration of gold purchases by central banks in the last quarter of 2024. We don't know yet about 2025, but I'm expecting that the central banks will be heavy buyers in early 2025.
The pace of gold's ascent in 2025 has been extraordinary. Gold has surged over 30% year to date, and we're not even halfway through the year. This remarkable performance far outpaces its historical average annual return of 8.3%. Since January, gold has risen by more than $800 per ounce, a rate of appreciation that eclipses previous bull markets. For comparison, it took 12 years for gold to climb from $1,000 to $2,000 per ounce, yet it has gained that same amount in just the first 4.5 months of 2025. This explosive move isn't merely driven by speculative enthusiasm. Persistent inflationary pressures, and a renewed escalation in geopolitical tensions, particularly the intensifying trade war between the United States and China. Farber emphasizes that the ultimate price target for gold is less important than the macroeconomic backdrop that will exist when it arrives. We know gold will likely reach those heights eventually, especially if money printing continues, he says. I'm not focused on the exact number gold will hit, like $12,000 or any other figure. What truly interests me is when it reaches that level, and more importantly, what the economic environment will look like at that time. On the other hand, CliveThompson highlights the growing role of central banks in sustaining gold's momentum. According to him, another uptick in central bank gold purchases is likely in the current quarter, and recent trends support this. Countries like China continue accumulating gold despite record-high prices, indicating that central banks prioritize long-term security and reserve diversification over short-term price sensitivity. Thompson notes that central banks are not buying based on price action. They are preparing for a less stable future. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I've taken the gold rally. We had a rally in gold from 2010 through to about 2012 or 13, which is on the chart, you're looking at a blue line on the left-hand side. That shows the gold rally over that 10, 12-year period based to an index of 100. And now I've started the rally, I've started the recent gold rally, which started, I'm going to say 2001. We can discuss what date the current rally started, but let's call it 2001. Sorry, 21. So 2001 to 2013 was the first one, the blue one. And 2021 to present is the red one on the far right-hand side, also rebased to 100. So what you see is that if this rally were to have the scale and length of time that the old one had, we're right at the beginning of the rally, and we've got not only many years to go, I think it's about 6 or 7 years to go, we've also got a huge acceleration in the price, because what you can see on the chart on the left-hand side, the blue chart, is that from about this point in the cycle, the price of gold started to accelerate upwards at a faster pace. So if this cycle were to repeat, and I know charts don't repeat themselves, but if it were to be the same, we would be now moving into the acceleration phase where gold moves up faster than it's been moving up in the early stages of the bull market.
I'm not so interested in the number itself. What I'm really interested in seeing is by when it gets to 12,000, and it will get to 12,000 because they keep printing money. By the time it gets to 12,000, what will the monetary base look like? What will the money supply look like? What will interest rates be? Will we be in a tightening phase and a loosening? That's what I want to know, because the 1970s rally topped out in 1980 because Volcker had pushed interest rates up to 20%, put the brakes in the money supply, and then just waited for, and then if you ask Ron Paul, they just waited for gold to stop going crazy, and then that was his signal that he could start printing again. So they can't do that this time. But again, the real question is not how far will gold go, but where will the dollar be? What will the money supply be by the time gold gets to wherever it gets to?
First of all, we've got a lot of interest coming from the central banks to buy gold. We've seen we've only got the figures up to the last quarter of 2024 so far, although they're coming in dribs and drabs for the first quarter of 25. But we saw that there was a huge acceleration of gold purchases by central banks in the last quarter of 2024. We don't know yet about 2025, but I'm expecting that the central banks will be heavy buyers in early 2025, particularly because of the uncertainties regarding the US Treasury market and the tariffs and what might happen next in terms of pressure being applied to other countries along the lines of, if you want to do a trade deal with us, we want to see you supporting the US Treasury market in some way, shape, or form. So perhaps before that pressure comes, some central banks are thinking we'll have a little bit more diversification and we won't keep all of our reserves in US Treasuries. We'll perhaps have some treasuries from other countries and we'll also have a little bit of gold. So I think that in the current quarter, the one we're in now, that's the second quarter of 2025, we'll probably still see another acceleration in central bank purchases. And we can kind of tell that's coming by just looking at the price. I mean, the price is at an all-time record, and yet we see central banks, at least as of the latest figure, let's say from China, for example, where we've got the March purchases already, we can see that they were paying record prices to buy gold. And they simply don't care what the price is.
Silver is again capturing investor attention as geopolitical tensions and trade risks intensify. With President Trump's new tariffs and China issuing retaliatory warnings, global markets face heightened uncertainty. Silver is emerging as a favored safe haven asset in this environment, drawing increased interest from institutional and retail investors. According to analyst Rafi Farber, silver is poised for a significant move higher. He notes that while its price potential is highly attractive, silver's volatility makes it a more emotionally challenging asset. For this reason, Farber suggests treating silver as a long-term investment rather than a short-term trade, with secure storage ideal for avoiding reactionary selling. From a technical standpoint, silver appears to be in a strong position. It holds above a key support level of $32.35, and momentum indicators signal continued bullish potential. However, analysts emphasize the importance of patience and discipline. As with any asset, letting the market confirm your bias is crucial. Jumping in too early can lead to unnecessary losses. A cautious, strategy-driven approach that prioritizes confirmed price movements and substantial trading volume is recommended for those looking to enter or add to silver positions. Let's get back to the interview.
First of all, I think you got to own a bit of everything, and I wouldn't even stop at silver and gold. You can go down to maybe platinum, for example, and then so your first stop, you should have some gold and physical silver where you can lay your hands on it very quickly in an emergency. That's the one you never ever sell. You keep forever, unless you really have no choice. And then if you have surplus, and I know you don't agree with this, Mario, but I think one can go, you don't want to have too much in your physical possession, at least not more than you can carry. You can go to the physical gold ETFs. Of course, you want to make sure where that ETF is registered. It's got to be in a country which you trust, and they've got to store the gold in a country which you trust. So physical ETFs where they've got the gold. And then you go to the miners, and there's several types of miners. First of all, you've got the large miners who make profits for the most part. I would say in today's environment, that's a pretty good bet because the price of gold is going up. So whatever they're digging out tomorrow will be worth more than it was yesterday. And it will take another 6 months or a year or 2 years before those profits start to come through to the bottom line and push up the share price, because some of the gold, maybe 50% of it, will have been sold forward. All gold miners, or I won't say all, many gold miners sell their gold, or not all of it, but some of it forward. But then you've got the more junior companies who perhaps are making a profit in some cases, but other cases, all they've got is the right to prospect for gold on the land. And they may have got the gold, they may have found it. And if they have found the gold, that can be a great thing when gold prices are rising, because the large mining companies will be looking to replenish their reserves. So they'll be buying some of those smaller companies who've got lots of reserves but no money to dig it out of the ground. And then the last thing you've got, which is really speculative, are the prospecting companies who haven't really got any gold yet, but they've got lots of people out on the ground hunting, hoping to find one of the holes in the ground. And that's really speculative, but of course if they strike it rich, those are the ones which can move the most. That end of the scale is not really for me. I mean, you can have your odd punt here, maybe one out of all your gold miners, but I would much rather be at the end where they're actually making profits today. That's much more reliable.
If you have all silver and no gold, even though gold is probably less attractive in terms of price movement, I would get gold now. If you have all gold and no silver, then I'd say definitely silver to me is much more attractive than mining stocks, just because the gold to silver ratio is like 103 now, and it's almost never this high. This is only the fifth time in human history. The first time was like 1933 when the gold was revalued from 21 to 35. It only took a few weeks for it to break back below the three digits. So look, it's the only thing that's holding the financial system together is the fact that silver hasn't gone crazy yet, but it's going to. It's going to at some point, probably pretty soon. So I'd say that silver in terms of just raw price movement is a lot more exciting, but it's also going to be a lot more difficult to hold on to unless you have it in like a vault where it's very difficult to get at, and you're just like holding it away no matter what happens.
Yeah.
But if you're trying to use it as a trade, you're probably not going to succeed. But silver to me looks very attractive right now. I expected silver to move with gold, but then I looked at the 1970s, and I think in 1973 and then again in 76, the ratio, not that it was anywhere near as high as it is now, but it hit a high for that 10-year period from 1970 to 1980. So 1973, 1976. And then it only really started to take off in June 1979. So June, even I think July even 1979. So you only had less than a year, well, for silver's real run. It was at the very end. So why was it the very end? Because the public only wakes up at the very end of a move. I mean, that's with all bull markets, whether it's .com or real estate or whatever. Like the biggest moves come at the very end of it, and that's when things start getting frothy. But the difference between a bull market in silver, at the very end of a bull market in silver, and the very end of any other bull market, is that at the end of any other bull market, the asset invariably crashes. For whatever reason, it always does it. But in money itself, if the currency cannot recover, and I don't think this time that it can, then you have, a runaway bull market in money and silver, and then it just stays there until silver recirculates in the economy to a point where it can serve as a new monetary base. So, and not so silver does go down, but not as a result of speculative furor dying off. It goes down as a result of the supply homogenizing throughout the economy and coming to a more where the point where the economy isn't begging so much for a distribution of a monetary medium because it has it already, and so then prices can start coming down in those terms, and people can start producing things. Like once they have the money to start exchanging again, you can start production again, and then supply of stuff goes up, and then the price of silver, in those terms, starts to settle down. But it's a monetary phenomenon, not a speculative phenomenon in silver. I think this time it won't be, at least.
Gold's explosive growth in 2025 has rewritten expectations, with its value accelerating at an unprecedented pace and underscoring the market's shifting confidence toward tangible assets. Unlike past cycles, this surge is grounded in deeper concerns about inflation, economic fragility, and rising geopolitical conflict. Central banks continue to increase their gold holdings, not for immediate returns, but as a hedge against global instability. Meanwhile, silver is gaining renewed momentum as a reliable store of value in uncertain times, though its volatility demands a steady long-term view. Together, these developments suggest that both metals are becoming more than just commodities. They're being redefined as strategic safeguards in a fragile economic landscape. Could this rapid transformation in gold and silver markets signal a broader global transition toward more resilient financial systems? Or are we witnessing a temporary flight to safety amid turbulent times? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.